All right. So welcome to the last session for the semester, the very last topic for this semester, and that is on financial crisis. So the idea is to touch on the key the crises that have taken place in the world, and look at how they were addressed, and then we can think about how this COVID, if it creates more similar, what are some of the characteristics that are similar to existing crisis, and see whether the solutions for the crises that have taken place in the past can be applied to our current situation. Okay. So what is the financial crisis? Think about, we are just looking at the financial part of the global crisis. The COVID can lead to financial crisis, but we are just looking at the financial crisis as a standalone and looking at the past ones, or what have triggered these crises. Okay, so a financial crisis occurs when there is a particularly large disruption to one information flow in the market. So when you have huge information asymmetry, okay, either you have a moral hazard problem or adverse selection problem. Okay, so if you have a moral hazard problem, you may be giving credit to people who do not need the credit, or who are not able to pay back the credit, but you are giving to them. Okay, or adverse selection, you are not able to pick out risky borrowers. You are giving a lot of loans that are leading to huge non-performing loans, NPLs, and all that. Okay. And our personal crisis in Ghana, you can find some commonalities when it comes to these information issues. Okay, information flows is very critical when it comes into a recession. Comes to discussing the issues of recession. So financial crisis occurs when there is a particularly large disruption to information flows in financial markets, with the result that financial friction increases sharply and financial markets stop functioning. Okay. At the beginning of the class, we looked at the function of the financial market, how you can channel funds from those who have surplus to those who need these funds for investment, for consumption. So if this market is not, if the market is not functioning properly, it will have consequences for all agents within the market. Okay. All right, so what are some of the dynamics of financial crisis? So you find that a lot of the crises, you have asset prices falling drastically, people losing their investments. Investments are worthless in the crisis. These are some of the consequences. Okay. All right, dynamics, what are the stages? We say the first stage, the stage one of a crisis, which is the initiation of a financial crisis. So it gives you some basics, some signal in the market that if you don't check properly, you may lead into a crisis. So the initiation of a financial crisis. The first case is something called the credit booms and busts. Okay, so you can have credit booms. Credit is being given to even everybody, basically everybody. Okay, there was a time in Ghana the banks would come into people's workplace, come for loans. People were buying cars that they can't afford, buying homes that they just can't afford. Okay, looking at their salaries is just too small. Their salary is too small to acquire certain things. But there's credit boom. They have a lot of liquidity and they want to give out the loans. Okay. So the regulator has to check these things. Okay. So the initiation, credit booms, and if they are not checked, they will lead to credit busts. Okay. So you lead to mismanagement of financial assets, leading to asset price booms. So all of a sudden, the value of stock prices, the value of stock, the value of investments just doubles. Value of houses just triples in an economy. And when the prices are increasing so much, you have to expect that if regulations are not put in place, there's going to be a bust, okay? Meaning that the prices will tumble. Okay, you have an investment in Boasigodi which is worth 100 million, but if there is a bust, it's probably worth 100 cities. Okay, so huge bust, and that can cause a lot of problems, or can be a source of the initiation of a crisis. Okay, so stage one is something that we have to check when the economy is having a lot of credit booms and busts. you have to be very careful, which can trigger asset price booms. Also, so the price of assets will just increase, and then a subsequent bust of these assets. So you can see those who are monitoring these markets, the Wall Street guys, they are always looking at the boom, and then they are predicting when it's going to bust, and then sell off just before the bust. Okay, so sell off, make a lot of money, tons of money, just before the bust. So that some of them are taking advantage of this, the understanding of an asset price boom and bust. All right, so you have credit booms and busts leading, also coinciding with asset price booms and busts, and then it creates a whole lot of uncertainty in the market. Okay, so now if there are credit booms and busts, and there are a lot of mismanagement of financial institutions and other things, then it creates a lot of uncertainty. If I have money, I'm not going to put that in the banking sector, and that is going to affect investment in the sector, in the investments and the economy, and then that's going to lead to all these macroeconomic issues, unemployment and all that. Okay, so it creates a lot of uncertainties in the financial system, and a general uncertainty for the whole economy. All right, so stage one is the initiation of the financial crisis. And then if not checked properly, it can lead to banking crisis. Okay, it can lead to bank panic. Now, I'm not putting my money in the banking sector, but I'm also going to the bank to withdraw all my investments, or not, right? I'm just bank runs, okay? And that is what we saw in the case of Greece some time ago, where people were queuing at midnight, trying to take out their money. So it can lead to a banking crisis, which have to be checked. Okay. And then stage three, you'll have a lot of debt issues, debt deflation. People just run into huge debt. Okay, and that is a big problem. And the real value of this debt will be very high, right? Because just think of it: you bought a home with a mortgage, and the home is worth $1 million right now, or $1 million cedis right now. And you are using that house as a collateral, right? So you've gone to another bank, use that house as a collateral. The house is worth $100 million or $1 million for collateral. The bank thinks that they have $1 million collateral, right? But when you have this asset or house prices, there's a boom where house prices just increases, and then there's a bust where where houses are worthless, and you have collateral that was worth 1 million, but now the house prices are worth 10,000. You've lost a lot of money. There's going to be a lot of debt. Okay, the bank or the financial institution that gave out these loans going to run into a lot of debt. Even though you have the collateral, even if you saw the collateral today, it's just worthless. Okay, so it's scary in the financial crisis if it's not managed properly. If it's not managed properly, you can have this credit booms and busts. You're giving credit to those who do not need credit or cannot pay back, and they are acquiring things, and you are using their houses and property as collateral. But the collaterals in the banking crisis or financial crisis is also worthless. Right? So if there's a bust, the price levels just declines drastically. So you are holding on to the asset, but you cannot get your money back. Okay, so these are some of the challenges. Okay. All right, so stage three can lead to huge debt deflation. All right, let's put everything into perspective, the sequence of events in financial crisis. So stage one, as we said, deterioration in financial institutions in terms of their balance sheets, asset price declines, assets are worthless in that setting. Some people also say that is the time to buy. If you are smart, you buy the assets when there's a bust, and then hope that there is an increase again and you sell. Okay. There are a lot of people who are Wall Street people who are into the smart business of buying low performing assets, and then hope that the market picks up again, and then they get gains from that. Okay. And as I said, it all leads into huge uncertainty, which will trigger all these second stage bank crisis, uncertainties, bank crisis. I'm not putting my money in the bank, and I'm also going for what I have. Okay. And if I'm not investing or putting my money in the financial system, it's going to have negative consequences for economic growth, economic activities. Okay. work and production and all that. So that is a similar case that we have. Right now, what we have here under COVID, maybe not this case of balance sheet deterioration and not asset price, but there's a lot of uncertainties. Okay. People are not getting salaries, so what you have saved, you have to guard against. So people may not be going into high investments, and therefore that can impact the economic activities and in that sense. Okay, so you try to find some similarities between the typical financial crisis and one that can be induced by a health pandemic. So you have the stage 2, which is the banking crisis, and then which will affect the economic outcomes. And then you have the stage 3, which will lead to unanticipated decline in price level. So stage 3, as I said, a huge debt. You are in debt, but the price levels have just reduced drastically. Prices of homes, prices of assets, they are worthless in a crisis. Okay, so unanticipated decline in price levels. Okay. Price levels are worthless. So today's price is very low. Even if you compare to real prices are going to be very high because you're comparing to a base year, right? So if you are owing in real terms, the raw debt levels are going to be very high. Okay. The nominal debt levels are, because of lower prices, they are not so much, but in real terms, the debt levels are going to be very high. Okay, so stage 1, stage 2, and then stage 3, where you have a huge debt deflation. All right, the mother of all financial crises is the Great Depression. The global financial crisis of the 2000s, 2006, 2007, thereabout, is one that we experienced, but the Great Depression in the 1930s is the mother of all financial crises. How did the financial crisis unfold during the Great Depression, and how did it lead to the worst economic downturn in the US history? Okay, so we consider this as the worst economic downturn in the US history. But if you follow the news, if you're following the news, the people are even anticipating that the pandemic may have the draconian effect on the US economy than the Great Depression, okay, so, which is scary. Okay. So these are some of the things that we have to keep in perspective. Okay, oops. All right. So this event, which is the Great Depression, was as a result of the stock market crash. Okay, so like the Dow Jones or international stock market crash. That would be like our stock market crash. That was the source of the depression. This event was brought up by stock market crash. I mean, prices of stocks the value was just declining rapidly. So if people have $1 million investment in stocks, it's just, you've lost money. Nothing has happened. There's a crash. The price increase, typically when when the price increases to a point, people begin to expect that it's going to crash. It's not sustainable. You remember what do you call it? The currency and the beginning of the electronic currencies that people were buying a lot, thinking that the price was increasing rapidly so much, and then all of a sudden it just collapsed. So the stock markets crash, and then you have bank panics, which typical bank panics, like a bank runs, people going to get their money because they've already lost a lot of money in the bank in stocks, and therefore they are trying to safeguard the little that they have. So it led to huge bank panics, and then which further declined stock prices, and also huge deflation in that sense. Okay. So it started with the bank crash and then ended in huge debt deflation, like stage 3. So this is the data that shows how stock prices overall decline. So stock market peaked around the 1920s, 29 thereabout, and then right after, prices just dipped. Okay, so you can see the change in prices. So if you were very rich prior to 2030, by 2032 you have lost a lot of value. Okay, lost a lot. So this wasn't fun. Stock market trough in December 1932 at 10% of September 1929 peak. Okay, so there's a sharp decline in the value of stocks. Okay, so that is what we have. And then the uncertainties can be measured by the spread here. And the spread is the uncertainty is in financial market, increase the spread between corporate bonds and the low risk treasury bonds. So you can see that the difference between the spread, the difference between the risk interest rate on risky bonds and risk-free bonds, that difference just widens. But it makes sense. If in a depression, you don't want to be putting your money into companies, right? So even if a company is selling a bond, they have to give you a really high interest rate for you to invest in. Whereas the corporate, the treasury bond or government bonds, you don't have to pay so much. They don't have to give you a higher rate. So the spread is very high. So it created a huge level of huge uncertainties in the market. Okay. And that is what we are saying, the initiation, the beginning of the financial crisis. All right, so the Great Depression is considered one of the worst recessions that we've had. Okay. The global financial crisis of 2007 to 2009 is one that a lot of people experienced. And the cause of the 2007-2009 financial crisis was not directly the stock market, but this time around it was the housing market, okay, the mortgage market. Okay, and those who have traveled through North America will see that this is huge. If you say the mortgage market is not that very big in Ghana, but in those countries, most people don't build homes bottom up, right? Like we do here. You have to get a land, deal with a bunch of land guards, and if you're not so scared, then you'll be able to build, right? There, it's not like that. It's okay. So companies are building, and they are sometimes financed by the banks to build, and then give it out to customers, and then they have to pay monthly mortgage. Okay, and then the mortgages are signed such a way that you pay over, like some cases, over your lifetime. Right, you are paying for the next 20 years. You are paying mortgage, and then before you own the home. Okay, so these are some of the that is their model, and its mortgages are. I can see a few mortgage companies coming up also in Ghana, but that is the idea. So there were a lot of innovations coming in how to finance mortgages. Okay, and so financial innovations emerged in the mortgage market. Okay, and the cause of the crisis, the global financial crisis of 2007 to 2009, was something we refer to as the subprime mortgages. Okay. What is a subprime mortgage? Typically, if people were getting homes, relatively poor people were getting homes at a reduced interest rates, right? So if a house, you know that I'm earning, I don't know, $1,000 a month, and even if you give me a mortgage, you cannot give me a mortgage more than 1,000, one. And if you give me a mortgage about 800, how many years, and the house is worth $500,000. How many years will it take me to pay this off? So what they were doing was they were giving lower rates to people who don't deserve loans, who cannot afford. Okay, so they were designing mortgages at a sub rates, which is a subprime rates. Okay, for people, for them to get, for everybody to be able to get a home, a mortgaged home. Okay, and that's the risky part, because a lot of people also did not have like stable jobs for them to month in, month out pay out these mortgages. And so it created this whole huge market where people were living in big houses they can't afford. Okay. Those days, if you had an uncle in the US, everybody had a home in the US. It's like, it was the new thing. People were buying homes in Pennsylvania and Ohio, everywhere, because Subprime, you just go to the bank, you show them a pay slip that you have been working at some factory. They know that because of the huge competition in the housing market, they could reduce the rate for people to acquire the homes. Okay, and it created this whole problem because at the end, a lot of people by 2007, 2008 could not afford to pay even the monthly mortgages. And then so you had so many homes, non-payment of mortgages, creating a huge problem in the financial sector. Okay. And the homes are linked to the financial sector. So if the people are not able to pay, it affects the profitability of these banks. All right, so subprime mortgages, mortgage-backed securities, and then the collateral debt obligations. They did something called the collateral debt obligations. And so the key difference when you look at the source of the crisis compared to the depression was that it was from the mortgage market. So you had, because people were giving subprime mortgages, housing price began to increase because there was huge demand for homes. Okay. Price levels of homes were just increasing, $500,000, $700,000, $800,000 homes, because people who could not afford were buying. If you even think of the demand curve, it means that the demand for homes just shot up or just increased drastically. And if demand for homes increases, price of homes is going to rise. Okay. But think of it, the demand, what is driving this demand is like it's not structure. It's not because the people have money. It's just because you are giving them lower rates to acquire the homes. Okay. So there was a housing price bubble, a housing price increase. So the increase in liquidity from cash flow surging to the US, and we found that a lot of Chinese were moving to the US to buy homes, and that further drove the price up. Okay. So a lot of foreign countries are always careful when there are a lot of funds coming from outside to increase the demand for homes. It's like we are beginning to experience in Ghana, and the home prices are very high. Okay, and sometimes you ask yourself, who are those living in those homes? Okay, very high. So you have increase in liquidity from this cash flows surging into the US, and development of subprime mortgage market forward housing demand and house prices. So houses were very expensive, and people who were living in them could not simply afford them. Okay. So they are creating this artificial demand for homes that is not based on increased wealth of the people. Okay. So, and that we as a country, as a developing country, should also be on the lookout. Okay. So we don't have similar things happening to us. All right. So a little more detail on that. So you have agency problem arising. Here you have originate to distribute model is used to solve the problem. It's like the banks are investors, and sometimes the mortgage companies are also linked to the bank, okay, like an offshoot of the bank. So it creates a lot of originate and distribute. You are creating the whole product, and you are also selling the product. And then borrowers had little incentive to disclose information about their ability to pay. Okay. They just can't pay, but their cousin got a loan by just showing that they are working, and then they hide some information about their bad credit history just to get the access to the loan. Okay. So borrowers had very little incentive. So if you live in a setting where you are giving all these mortgages to people who just simply can't pay, or they are hiding information about their ability to pay, and there's lots of people in that bracket, then we are all in big trouble going into the future. Okay. So these are the issues. In Ghana, because we culturally and socially, we pride ourselves in building our own homes. Maybe a subprime mortgage type, it may take a long time for us to be exposed to this kind of onset crisis. Okay. You never know. You never know. Anyway, commercial investment banks as well as rating agencies had weak incentive to assess the quality of securities. Okay. Even if you bring all the documentation, they don't have the incentive, but they want to sell off the homes rapidly. There's huge competition in the market, and prices have increased. And they are using this artificial increase in home prices to estimate their profitability, saying that the homes that are under their belt is worth 1 million. But if the price tumbles, if there is a reduction in price, it's going to affect the value that they are holding on to. So information problems surfaced under the financial crisis, housing price bubble, and then so you have the bust, and the bust was not a joke. Okay, people were losing their homes. The banks were selling off homes at lower prices because if you miss your payment for a number of times, you're not paying the mortgage. The bank will confiscate the home and then sell it off. Okay, in a crisis, the bank will sell, but will not sell at a very high rate. So they are going to take a lot of losses. Households will take the losses because they are not able to sell at that $1 million that they think the house is worth. And the banks, when they take it, they'll try to sell it close, but they also lose a lot of money. And if a lot of banks are losing money on homes, that is huge. Okay, that can disrupt the whole financial system. Okay, the way the US is structured. So information problems surfaced. Housing price bubble bust are very obvious. And then this led to the creation of a collateralized debt obligation, involves a corporate entity called as SPV, just like we did for the consolidated bank type. Okay. So that SPV, special purpose vehicle, that buys a collection of such assets. Okay. So buy the collection of such assets like the corporate bonds, the loans, commercial mortgage securities. So because of this situation, they create all these special purpose vehicles that deals with all these bad bonds that have gone, this whole bad investments. Okay, so it's like a bunch of mortgage companies have collapsed. You have to put them all under one umbrella, like this SPV, and then have the if it's a consolidated, the consolidated bank idea, this consolidated bank then goes after those who have bought and try to recoup some of the money. Okay. So the creation of a collateralized debt obligation involves corporate entity called as an SPV, special purpose vehicle, that buys a collection of such assets. So the bonds, loans, commercial real estate bonds, and mortgage-backed securities, they take over these securities. And SPV separates the payment streams from these assets into a bucket that are referred to as tranches. Okay. So it's like the consolidated bank would do, they take over all these banks and then look at the payment streams, okay, cash flows, meaning those who bought the homes, how many people can they collect some mortgage from? How many do they have to just completely take over and sell? And then the money that comes into this bucket, they have to make a decision who they are going to pay first. For example, I've invested in a mortgage real estate bond, right? They have to pay me back my money. But if the home prices have just lost values drastically, and SPV takes over these bonds, then they have to sign a schedule on how they will pay. Okay. And how much they will pay depends on whether my investment was an equity or debt. Okay. If it's debt, then they have to pay me first. If it's debt, they have to pay me first. So once they put everything into this debt obligation, collateralized debt obligation, the highest rated tranches are referred to as senior tranches, and they are the ones that are paid first and so have the least risk. So the debts have to be paid first. Okay. And the equities will be the last. So the lowest tranche of the CDO is the equity tranche. And this is the first set of cash flow that are not paid out if the underlying asset goes into default. Okay. So if you're going to equity you have equity investment in the housing corporation or a bond, you'll be the last. And if the company loses, there's a lot of defaults, you'll be the first to miss out on receiving payment. All right, so this tranche has the highest risk if you are an equity investor in a recession in this form, or equity investors in housing market. The housing market boom, a lot of people were investing somewhere, they went into debt investment, others went into equity investments. So if it's equity, you'll be the last to be paid. Okay. It's like leaving the banks. If I have equity in a bank, they have to pay all those depositors first before they pay me. Okay. So the SPV, special purpose vehicle, will be this consolidated bank. Then now they take over all the assets of these banks and they look at the cash flow and they make decisions how many people they will pay, who are depositors, and how many institutional investors they will pay. Okay, so that is a similar thing that is done in the event of a housing bust. In the event that the house prices just reduces drastically. We also have to be on the lookout. The homes in Accra, it's insane. The price of homes. Okay, so many $30 million for a home, 40 million for a home, and so it's so high. $1 million for a home, so high that if there's a bust, we hope coronavirus doesn't cause a bust in the housing market. It could cause a bust if you think about it. Okay. A lot of these homes are being rented by international organizations for their staff and all those. And if after COVID they decide that they don't need so many people to be in Ghana, it's going to have a huge effect on the housing market. Okay. And then that can lead to a reduction in prices of homes. And for that reason, those who took loans, so much loans to invest in those homes, can only sell it at a reduced price. They may be making a lot of losses on the home. So something that we should also be thinking about. Okay. All right. So some of the effects after the sustained boom, like people getting homes that they can afford, house prices began to rise a long time before. Then the decline started in 2006. And by 2007, we were in a full-fledged housing crisis. Okay. The decline in house prices contributed to a rise in defaults. People could not afford to pay. It was scary. Okay, there were people, I remember in Pennsylvania, even Ghanaian families, people were moving back to Ghana in 2007-8. They can't afford to pay their mortgage. They have run into so much debt. Default rates were high. Okay, so they can't afford it. All right, so on mortgages, and then the declining house price contributed to a rise in default on mortgages and a deterioration in the balance sheet of financial institutions, because the house markets were closely linked to the housing market. The bank sector, financial sector was closely linked to the banking sector. So that led to this declining deterioration in the balance sheet of financial institutions. This development in turn caused a run on the shadow banking sector. Okay. So it then went into affect the stock markets and all that, and the other markets, other financial products. Okay. Crisis spread gradually. So for any crisis, there can be a contagion, right? It can spread. Okay, so crisis spreads globally. Even if it's starting from the US, it ended up impacting the UK, the European Union, Greece, Italy, Spain. They all had their share of this crisis because of the internationalization of the financial sector. Investors in that market, some of the investors are foreign investors from Europe also. So crisis spreads globally. Sign of the globalization of financial market. Financial market is really globalized, that what affects one country can affect the other. Okay. People are raising money also in the North American market, investing in Ghana. That will also be affected. Okay. Even though we are far from the US, there are some effects. We may have some of the consequences we will have to deal with, but may not be as much as those who were in it by them, like in the case of the States. Okay. All right, so this third spread, the 3-month interest rate on Eurobond minus the 3-month treasury bill rate, as I said, it creates a lot of uncertainties if there is a huge spread between corporate bonds, rates on corporate bonds, and that of treasury-free bonds. All right, and the deterioration of financial institutions' balance sheets, we mentioned that. Write-downs, sell of assets and credit restrictions, The banks just wanted to sell off the house asset, but they were afraid that the price will even further drop. So they want, if the house is going for $1 million, they will sell it for 800 if people they have a market for it. But they're afraid is that it will hit about 400 and they'll lose about 600 million. So 7,000. So those are some of the selling of assets at reduced prices. But then it's affecting the balance sheet of these banks or these financial institutions. And then you heard about all these high-profile firms failing, Best, Steams, Fannie Mae and Mac, big house corporations, big companies, Lehman Brothers, Reserve Primary Funds, a lot of fund companies, Washington Mutual, a lot of fund companies were collapsing. And then the US government had to go into a bailout for some of them. And that is where some people are also articulating the point that maybe some companies in Ghana under COVID should be bailed out. Okay, so the bailout packages debated. So if you go through the history, there was a lot of debate about the bailout. And in a sense, in the recession, you want to trigger huge investment. So there was a lot of money going back into this company, trying to see if they can survive. The price levels were falling. So what do you want to do? You want prices to increase again. So if you pump in a lot of money into the sector, people have money and aggregate demand will increase again. Okay. If aggregate demand increases again, price levels will increase. So they went into bailout packages. House of Representatives voted for 700 billion to bail out these companies that were failing, and these banks and all that were failing, just like we also tried to do in our case. Okay, and it was passed by 2008, and then they approved even more, 787 billion economic stimulus package was also passed. Okay. So the bailout was there, and then the stimulus package was also there. You can see how house prices increased and dipped around that period. So price was increasing, and then it hits the peak, and then after the peak. So it's like we are all sitting on the time, but we don't know where the peak is. And then once it hit the peak, you begin to see signals that it's reducing. And then by 2008, some house values have lost so much, lost so much value in terms of the price of the home. Okay. So you have to look at the data to see whether we have reached the peak. Okay. So stock prices also had a similar trajectory. Stock prices were increasing, and it goes to a peak and then also dipped. But the source was coming from the housing market. It triggered other effects triggered similar reduction in other prices in the market. All right. And then they went into a whole game. Who was to be blamed? Is it the central bank? Is it the policies that have been put in place? Some economists have argued that the low interest rate policies of the central bank between the 2003 and 2006, prior to the crisis, led to the housing bubble. So in effect, the US had a very low interest rate. And the low interest rates will mean that I've always been telling you guys in class, if you have low interest rates, even those without ideas will begin to have ideas. Okay, so the low interest rates led to a lower interest on homes. Okay, and that is why people who could not afford were able to afford homes. So Taylor argues that the low federal funds rate led to low mortgage rates that stimulated housing demand. Okay, so the low rate stimulated higher housing demand. Higher housing demand means that higher prices of these homes. Okay, and that encouraged the issuance of subprime mortgage because of the lower mortgage rates, both of which led to rising house prices and then a bubble. Okay, so an increase in price of these homes. And so it became lucrative that if you buy a home at 700,000, by the time you sell it, the price would be 1 million. You sell and you make 3 million. People were going into huge housing investment, thinking that they will make profits, and they lost. Okay. All right. Federal Reserve Chairman at the time, Bernanke, countered this argument, saying that the corporates were not the central bank lowering rates, but because of the proliferation of new mortgage products that lowered mortgage payments. So they were just trying to absorb themselves from the blame. Okay. So the new mortgage product that lowered mortgage payments, a relaxation of lending standards that brought more buyers into the housing market, and capital inflows from emerging market countries. So they were blaming others, that people were coming into the US with a lot of money to buy homes. And so it increased the demand for homes and then, or demand for construction of new homes. And then they were given to people who could not just afford. Okay, so the debate over whether monetary policy was to be blamed for the housing market still continues to this date. Okay, but it's true that you have to be careful that you don't lower the policy rate too low to the point that it can trigger some of these negative consequences. All right, and then you can look at the global effect of this crisis, the sovereign debt, European sovereign debt crisis that had hit some of the countries. Greece, for example, was hard hit by the crisis. The increase in budget deficits that followed the financial crisis of this led to fears of government default and surge in interest rates. A lot of European countries could not honor their debt obligations, so it led to huge sovereign debt crisis. And then the European Union has to then come in and bail out some of these countries. Greece was very hard hit, and then it moved on to Ireland, Portugal, Spain, and Italy. Okay, so a lot of bailouts for them also. The stresses created by this and related event continue to threaten even the viability of the euro up to today. With Britain leaving the European Union, these are some of the consequences. Okay. And some of the Irish, I think one of the Ireland, Northern Ireland, or one of them still wants to remain in the European Union because of some of the support they got, the bailout support they got. All right, the height of the crisis, 2007, 2008, as I said, the stock market also crashed. Which you saw the data. Okay, and then if you are having a case where the prices are going down, home prices are going down, what it means is that you will not have people building newer homes, right? Because the prices is just tumbling, right? So you will not have people doing that. Corporations that have invested in the housing market or stock market will lose a lot of money. So Chrysler and Co. lost a lot of money. So they could not invest in building new cars. And even if they do that, who is going to buy it? People have lost their money in homes, on housing, and they've lost their money in stocks. Who's going to buy? So this led to a huge unemployment situation. So the unemployment rate shot up, going over 10% level by late 2009. Okay, so it led to huge unemployment, both in lots of states in the US. Okay. Think about this. We are complaining that it led to about 10%. Under the current COVID situation, there are predictions to show that if it's not handled very well, it may lead to unemployment rates beyond 15 to 20%. Okay, so put it in perspective, it means that we need to be very careful that it doesn't have strong consequences for our banking sector, for our housing market, for the stock market, and also for the banking sector. So the unemployment rate shot up around that time. A lot of people were losing their jobs. You have bought a home, think of the scenario, you bought a home at $1 million, you have lost your job, so you're not able to pay mortgages, or you've not been able to pay mortgages for 3 months. The bank confiscates your house, you are homeless, and the bank is not able to sell at 1 million, so they're selling at 700, they are also making a loss. And then over time, the bank is not profitable, it's taken over. Government comes to bail out these banks, but you've already lost your home. So unemployment was huge, and they said that it's one of the worst economic contractions in the US since World War II. Okay, and so we hope that the current situation we find ourselves under COVID, we don't surpass this World War II levels of unemployment. Okay, so that's for the credit spread that we talked about. Government interventions and the recovery. What are some of the policies that governments around the world implemented to deal with the recession? Okay, short-term responses and recovery. What are the short-term responses? The first one, financial bailouts. Okay, in order to save the financial sector and to avoid contagion, financial support was provided by many governments to bail out banks, okay, and other financial institutions, and even the so-called big companies. Okay. So, and then the fiscal stimulus package. So you are supporting the banking sector. You have to support people who have lost their jobs and other small businesses. So to boost their individual economies, most governments also use fiscal stimulus packages that combine government expenditure and tax cuts. Okay, so they reduce tax rates for the poor or the vulnerable. So short-term responses, Japan, what they did was, the Japanese case, Japan consecutive stimulus package. They did about 568 billion package, stimulus package. And this is considered one of the highest at the time for their people. But this proved largely ineffective. Okay. So you're pumping in money, but it's not solving the problem. Okay. Because of uncertainty, even if you give me money as a firm to go on to start production, I'm afraid that if I produce, nobody will buy. I have the money in billions, but I'm skeptical about investing. Okay. So in a crisis, these uncertainties could create more problem and may not make these policies very effective. Okay. So Chrysler was not producing, even if they take the bailout money, they will try to produce, but there's no aggregate demand in the market. Okay. European nations showed moderate success with their bailout packages. And Latvia, Latvia, different and controversial response. Latvia's independence from the USSR and its fiscal policies helped it join the European Union in 2004. So, and the European zone in 2014. And the economic policy had a low budget deficit and a fixed exchange rate. So with their crisis, when they got the bailout in 2007, the country's second largest bank needed about 7.5 billion to recapitalize. And by doing that, they also kickstarted an austerity program. Citizens, this is very interesting. That's why we put this on the slide. Citizens voluntarily endured the layoff of about 25% of state workers. They accepted that their country was in big trouble. So 25% of state workers lost their job, but it didn't lead to any political upheavals. And then 40% salary cuts for public sector workers. Okay. They all agreed that, and they reduced a lot of social spending just for them to recover from this recession. Okay. After a contraction, so the economy contracted, for a contraction of over 25%, the country's GDP started to grow to its near pre-crisis level. Okay. So these are hard decisions the countries have to take in crisis. Okay. Because instead of laying off so many workers, which they did, then those who stayed on lost some job, lost some salary. At least they still secured their jobs. Okay. And then expansionary contraction, expansion and contraction, success in Latvia, but may be inapplicable in other countries because of their political motivations. Okay. They have a strong political system after their separation from Russia, so they are able to implement this. It is very difficult in a very liberalized state to cut down 25% of state workers and then to reduce 40% salaries just for your economy to recover. All right, long-term responses with the individual emergency national bailouts to rescue national economies and financial sectors. Global leaders look to building a more sustainable and robust financial system. What do we do to strengthen the international financial system? Okay, so steps taken by government included to implement sound macro policies, enhance their financial infrastructure and also the monitoring, develop financial education and consumer protection. So if you can't afford a mortgage or a loan, you don't go for it. And if you do go for it, use it for an productive activity. Enact macro and micro prudent regulations. So regulate both the financial sector and the housing markets. At the international level, proactive global binding supervision, financial market, because they were concerned that people were bringing lots of funds into the US. They have to also strengthen strengthen the system that regulates the flow of finance, right? People may bring lots of illegal funds into their country, so they have to regulate these things, money laundering and all those. So financial market discipline, enforce, and systematic risk management. So you have to manage risk in your country. All right, and to avoid collective action problems and to ensure that policy actions are mutually consistent with national growth, agri plans began to be drafted simultaneously. The famous one is the mutual assessment process launched in 2009 by the G20. So the G20 had a holistic framework for assessing some of these risks that can harm the financial system, but also both the systems that can cause a recession. Okay. So you have the breakdown of the policies from the short-term solutions, the bailout, the fiscal stimulus packages, and then you have long-term solutions looking at what you can do within your country long-term, which the macroeconomic stability and all that, to how to use sign accords with other countries on money laundering and all these illicit monetary transfers. And so that is important that we don't enter into another financial recession. Okay. All right, I'm going to end this session here. So thanks for listening to the session. We'll have one live session, and then in that live session, we'll go into how the format of the exam. Okay, the exam timetable will be out very soon, and we'll think about what will be the best format for the exam. I wish you guys the very best. Take care.